Thanks everyone for attending. I'll jump straight into the presentation. I'm sure everyone would like to get to lunch for those on the Eastern Seaboard. So Prime Financial Group, if we could just go to the first slide, please. So let's start with the highlights of 2022. We had a great year. The team performed exceptionally well, and that was represented by an increase in our underlying EBITDA of 15% to 7.8 million. We also had revenue growth of about 18%, which in fact was actually our best revenue growth we've had for a number of years. And it's really starting to show that our strategy for growth is working well. So up 18%, 26.3 million in total revenue for FY22. EPS was up 14%. It would have been up slightly higher, probably closer to 30%, if it hadn't been for us subletting our office space here in Melbourne that we didn't need anymore, or half of it at least. We've also had an increase in our dividend, which is up 57% to 1.1 cents per share. Our margin was maintained at 30%. That's grown from 19% to 30% over the last 4 years. And we've also been able to substantially reduce our debt to a fairly modest 0.7 times underlying EBITDA at 5.2 million. That was down 26% for the year. Our operating cash flow remained very strong, up 11% to 6.1 million. So overall, the scorecard looked pretty strong, and the team did a great result. Next slide, please. Some other important information in terms of our growth prospects and how we've been developing the business. The team actually grew by 30% over the last 12 months. Now got 130 team members, which I'll talk about in a little bit more detail in a moment. We've also got an equal focus now on organic and inorganic initiatives. In fact, we actually completed a transaction earlier this week, our first transaction from an acquisition point of view in the last 4 years. As I mentioned before, our dividends are up 57% in FY22, but importantly, we're also forecasting that they'll increase by a further 36% in FY23. We have a buyback in place. We've currently spent about $900,000 buying back our own shares. That will continue on into the future. Next slide, please. So I thought it'd be worthwhile just touching on the business's performance over the last 5 years. We repositioned the business in 2018, and what you can see here, when you look at each one of these key metrics, be it underlying EBITDA or reported profit after tax, there's been a substantial improvement and a consistent trajectory in terms of our increase. You've seen underlying EBITDA move from 3.7 million up to 7.7 million in 2022 from 2018. You see the reported after-tax profit go from 1.3 million to 3.8 million. EPS has gone from 0.77 cents per share to 1.93 cents in 2022. And our dividends after dipping in 2018 have consistently grown to be 1.1, moving to 1.5 cents per share in 2023. The share price there, as at 30 June, at the end of each one of those financial years, is highlighted. It bottomed out at 6.5 cents, moving to 17 cents on 30 June 22. Today, it's around about 22, 23 cents as we stand. So overall, what you're seeing here is the strategy we put in place in terms of one connected, consistent advisory and capital firm is really starting to play out in a positive manner. Next slide, please. So a little bit more detail on our firm. So we are an advisory and capital group. We do pride ourselves on being able to deliver multiple services to our clients. The clients sit in the middle, and we surround them with services including accounting, wealth, corporate advisory, and also SMSF admin. We also look after about $1.1 billion of clients' funds at the moment, and the business has been around for about 25 years. Our core offices are in Melbourne, Sydney, and Brisbane, and our purpose is all around empowering our clients to achieve their aspirations, but also our team as well. Our team is a super key focus for us. And as I said before, we have 130 team members that are split across those locations, but we do operate a very flexible staffing structure, which allows people to operate from pretty much wherever they need to do their job well. We have a centralised services structure, which is substantially based in Melbourne, but we also have team members in the Philippines. Centralised for a key reason: we don't want to replicate costs throughout the business in different locations. So that's allowing us to get leverage, and it's the reason why we've been consistently improving our operating margin. Next slide, please. So how are we growing? Probably the most important point here, and there's a fairly important statement that starts this. In FY22, we had revenue of $26 million, Over the next 3 years, through organic and inorganic activity, we want to grow revenue to $50 million. We're doing this in 4 ways. 1, organically. When I show you the service line revenue from our 4 key service lines, you'll see that they're all growing organically, and they grow organically through 2 key areas. 1 is our partners going out and securing new clients, and 2, our existing clients being referred into other divisions where they need additional services. The other way we're growing is by attracting new team members, new professionals, accountants and advisors that have their own existing client base where they want to be part of a bigger firm that can offer more services to their clients and where they can become an owner in the business as well. So that's another key part. That's number 2. Number 3 is new service lines. As I said before, we have 4 service lines, but we consistently deliver and build new services that are relevant to our clients. In the last 5 years, the 2 new service lines that we've put in place have been corporate advisory and also SMSF admin. And those 2 service lines now account for over $7 million of the $26 million of revenue we had in FY22. We haven't undertaken the 4th point for the last 4 years. We've been focused on organic growth and new services, but we are now in a position to acquire other businesses that are complementary and where we can add value to that particular business. And I'll talk a little bit more about Intello in a moment, which is the acquisition we completed at the start of this week. Next slide, please. Okay, so Intello. So on the 4th of October, we acquired 100% of Intello. Intello is a B2B SMSF administration business, and that will fit squarely within our SMSF service line. The business that we have acquired has around about $3 million of annual revenue. It will contribute about $900,000 plus of EBITDA to our firm. It is highly EPS accretive. It is a cash transaction, $4.6 million with 70% paid up front and 30% in 12 months. This is all being done it's being funded through operating cash flow, but also through an additional facility we have in place with Westpac, which I'll speak about in a moment. But it's also being done in the context that we don't want our debt to EBITDA to be more than 0.5 to 1 times, which is where it's currently sitting at the moment. So for context, when we talk about the SMSF division, in FY22, it made up 10% of our revenue. With this transaction, which has a fantastic team, which we're really encouraged that are joining us, that revenue will move to being 20% of group revenue into FY23 and beyond. Next slide, please. As I mentioned before, one of our 4 strategies is acquisitions, and that is something that we've been very modest in approaching in the last 4 years, but now it'll feature as part of what we're doing. So in order to fund that, we have put an additional facility for acquisitions in place with our banker of 15 plus years being Westpac. That's for an additional $10 million. Clearly, $4.6 million of that has been spent on this first transaction. The limit that we have in place now with Westpac is $20.6 million. And as I said, all transactions will be looked at through the lens of not having our debt be more than 0.5 to 1 times underlying EBITDA, and that will be measured on an annual basis. Next slide, please. So a little bit of detail about our capital structure and some of our peers. So our market cap, as Tim said, is about $45 million. We're currently trading at about 10 times 2022 EPS. We've got a 5.5% fully franked dividend, and I'll talk a little bit more about the shape of our dividends into the future, as I've already touched on. Importantly, we are a business that takes ownership by staff as a key metric. Something that's really important that we all act as business owners so we get the right return for all shareholders. So 44% of our firm is owned by key management and staff, and team members, once they've been with us for 12 months, start earning the opportunity for equity on the basis that we all perform together and deliver growth at share price level and also at the earnings level. Our key comparable companies are listed there. Really, Kelly Partners is the business that is most closely aligned to what we do, but we also have probably more diversity in what we do because we're across accounting, wealth, corporate advisory, and SMSF. Next slide, please. So a little bit more detail here. I've touched on a lot of this, so I'll only spend a second here, but $26.2 million of revenue, contracts with customers, EBITDA of $7.8 million, the margin of 30%, and our final dividend, which was actually just paid on the 30th of September, of 0.6, but you'll see the interim for 23 go to 0.7, and you'll also see the final for 23 go to 0.8. Next slide, please. So here's a little bit more detail on the 4 various service lines that make up that $26.2 million. So our accounting operations are at 10.4 million for FY22. You see that's grown by about $500,000. You also see the wealth management business, after coming down for a period of time and being realigned, is now back in growth mode, up $900,000 between 21 and 22. Capital and corporate advisory, the second newest service that we've got, has had a consistent growth path. That will continue. And SMSF, all of that is organic growth there to 2.8 million. That will continue organically, but also through the acquisition completed earlier this week. So as a reminder, we'll grow the firm by continuing to grow organically in these 4 service lines, but also through new revenue contributors and also through acquisitions as well. Next slide, please. A little bit more detail here about our cost management. I mentioned the centralised service structure that we've got where we keep costs down. What you'll see there between FY19 and FY22, we're now pretty much at the same cost base, but obviously with substantially more revenue. So we've been able to manage the business efficiently, and that's part of the reason why the operating margin has improved, as has our underlying EBITDA, which you can see below there has moved from 5.2 million in FY19 to 7.8 million in FY22. Next slide, please. Margins I've mentioned, so nothing more there. Our debt peaked at 9.8 million, being 1.8 times underlying EBITDA. Now back down to 0.7. As I said, it will remain in that range. Our operating cash flow is very strong. In fact, it's about 4 times higher than what it was in FY19, and has allowed us to equally do a few different things. 1, increase our dividends. 2, buy back our shares. 3, undertake acquisitions as well. Next slide, please. So dividends here, this is a really encouraging shape. We pay out about 40 to 60% of our maintainable earnings. We paid out 52% in FY22, but we are confident that with that strong cash flow I just mentioned, we can continue with that trajectory into FY23. And the dividends are an important part of making sure our shareholders are getting the right return. Next slide, please. Balance sheet, I've touched on this, so I'm not going to really speak to this in any more detail. We might skip through to the next slide. Outlook, the important thing. So this outlook was produced at the time when we reported our results in August. So this hasn't changed subsequent to the acquisition. We'll update our outlook at our AGM, which is at the tail end of November. But we are looking forward to continued growth in FY23. Revenue will grow at 15% plus. We'll see an increase in our underlying EBITDA of at least 5 to 10%. EPS will grow by at least 15%. We'll continue actively exploring new service lines, new people joining us with existing client bases and acquisitions. The dividends will increase by a further 36% in FY23. The debt will remain as mentioned. The buyback will continue. And most importantly, we've got a great team and we want to encourage them to grow and become owners in our business. We think that is strongly correlated to developing a strong business for the future. That's the prime story. That's where we're at the moment, Tim, in terms of outlook. And yeah, look forward to taking any questions you may have.
Thanks, Simon. Yeah, quite a few questions here. Now, while you're not strictly a financial advice business and you've got those other divisions and verticals, if you like, you've got really attractive margins, which is potentially surprising. Where are those margins coming from?
Yeah, so across the business, it is 30%. And what you see is that, as an example, in our accounting division, we've got about a 35% operating margin. In the wealth division, it's approximately 27 to 28%. The SMSF division, because it's kind of the baby and the newest division, it took some time to become, to generate a positive margin. Last year, it was around about 20%. And our corporate advisory division is the same. It's anywhere between 30 and 35% on an ongoing basis. So it's pretty well split across the business, but encouragingly, we've got 80% of our revenue is recurring in nature. So that allows us to make prudent decisions about growth, and it allows us to be considered in how we go about, improving the business from a long-term perspective.
And you've mentioned future M&A. What sort of segments within the financial services industry are you looking at?
Yeah, so we encourage all of the MDs of our various sort of divisions to think about acquisitions, but not to just do it on the basis of what it might be good for their particular division. We've pushed really hard for this mentality of one connected firm and doing multiple things for our clients. So when we look at a transaction, it's not just about whether or not we could operate that business, whether it's complementary, but in fact what it could do for our other divisions. So there's a few different lenses that we look at it through, but we encourage everyone to look at it, and then the board makes an informed decision based on what fits most into the strategy.
And for a potential investor that's kind of looking at your businesses to become a shareholder, you've kind of increased debt and you've been undertaking a buyback, and the cash in the bank is quite low, but you're talking about paying dividends. How does a potential investor kind of reconcile the balance sheet?
Yeah, look, I think with a business like us, we've obviously got strong cash flow, so it does afford us some choice. We're not too lumpy in terms of how we generate our earnings. So that allows us to think about things on an ongoing basis. So we didn't do transactions for 4 years because we were focused on the organic growth, centralizing our structures and creating the right margins. We've done a transaction now. If you suggest I was going to do transactions every 6 months, that wouldn't be correct. This is a pretty material transaction for us. But over the next year or two, we'll look at another transaction, but on the basis of keeping our debt within that range of 0.5 to 1 times. We balance the buyback based on the share price and what we think is fair value, but dividends are a priority in terms of what we think about for total shareholder return as well. So it's a constantly evolving consideration, and one that we tinker with as we go through, but we keep consistent in core philosophy around debt and dividends.
And there's a question here in regards to your share count has increased from 170 million to around in 18 to around 200 million in 2022. Where's that come from?
So part of that would have been acquisitions that were undertaken in the prior period, where there's been shares that have been issued because team members or businesses that we've acquired are now ongoing team members. That's different to the transaction that took place earlier this week. That's a cash transaction. The owners are involved with the business for the next 12 months, so there's not that ongoing requirement beyond that. So the share issue goes up purely because of two key things: acquisitions where shares have been issued, but also under performance rights plans as well, where staff get shares if there has been an increase in our earnings and our share price, and each have to increase. The share price has to increase 20% per annum, and the earnings have to increase at least 8% compound each year as well. So they're the two mechanisms at which we'll see the share price number of shares increase. But obviously we've got a buyback on, and that's why it's starting to come down again.
Thanks, Simon. And just to finish up, the economy is a bit patchy at the moment. Do you see that impacting your businesses at all?
Yeah, look, I think the benefit we've got is through the diversity of those various service lines. I think what we've found over the course of the last 3 years through the pandemic is just how resilient our business is, and that diversification has been helpful. And I think there's just a constant need for all of our clients, whether they're businesses or corporates or individuals investing their wealth. They need advice. So yes, you'll see things that move around from time to time, but even through last year, which was touched on by the pandemic, we grew our revenue by 18%. So I think the recurring income and the diversity gives us a good position, but things will move around from time to time, but we're pretty confident about our future.
Simon, thanks for your time. Thanks for the update. Have a nice weekend. We'll catch up probably next year.
Great. Thanks, Tim.